Welcome to Tradespoon and Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of Yellow Tunnel and Tradespoon. And today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions, Tradespoon or Yellow Tunnel subscriptions, and any questions you might have on how to use Tradespoon technology and take advantage of the current market conditions. For those of you who are new, welcome. If this is your first live event, do me a favor, just type in first. Always want to welcome new Tradespoon subscribers and Yellow Tunnel subscribers. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab in 2011. At some point, the company was worth over $2 billion. I'm very proud of the experience. Since I left Options Express, I work as a consultant and investor in several financial technology firms here in Chicago. I started Tradespoon in 2012. I want to take this opportunity to say thank you to all the Tradespoon and Yellow Tunnel subscribers. Because of you, I'm able to do what I enjoy professionally. Managing and trading my own money, I've been doing that for over 15 years. Mentoring and teaching Tradespoon subscribers how to trade stock and options. And I have a master's degree in computer science and statistics. And finally, my latest passion is trading psychology. I think that's an important part of trading journey to be successful in trading. Trading psychology is just as important as statistics, and hence the idea behind Yellow Tunnel. So Yellow Tunnel is specializing in trading psychology, how to deal with emotions, and how to be more self-aware when you're trading. Which I think is an important part of the trading. Disclosures: trading stock and options involve risk and are not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that the future trade picks will be profitable or will equal past performance. And you can see the relationship between Tradespoon and Trading Block on the bottom of your screen. All right, so let's first, before we get into a trading plan and trading system, let's talk about current market conditions. So the model predicted today's support to be at 307.59, overhead resistance at 317.39. Right now, the market is at 218.06, which is a very impressive rally based on the better than expected unemployment numbers. Some people would say unemployment numbers would get closer to 20%. They ended up being less, actually rehiring starting in May. So definitely a positive surprise in terms of how quickly the economy is restarting and unemployment numbers are going down. And that will be the theme, I think, for the until the elections. How quickly is the economy restarting and people going back to work versus how versus prolonged recession, right? So that's what drives the market. We are at 318, 320 levels, so definitely positive surprise. I think, including myself, I didn't expect the market to get to these high levels at such a rate. But at this point, again, I think I would not be surprised that market will just continue to go higher because of the unemployment number. The next catalyst that can bring the market to the downside are the earnings, right? The earnings will start in the next couple of weeks, in the end of June, beginning of July. So after July 4th, I think that what can bring the market to the downside. But as of right now, I think, I would not be surprised in the next couple of weeks that we actually reach 300, 52-week high, all-time high. We are already at basically almost positive or positive for on year to date. So strong rally to the upside, basically driven by two very important indicators. Is the dollar, right? US dollar is oversold. Strong move to the downside, retesting 2020 lows, 2019 lows. Short-term oversold. I do expect a bounce. Even today, even though the market rally, dollar is positive. So I think it will rebound back, and that's what will pull the market to the downside short-term, short recovery, potentially to 200-day moving average. But strong, weak US dollar, which is great for the commodities, emerging market, multinationals, and the treasury. right? So strong sell-off in treasury prices and unemployment numbers, going back to potentially September of 2019 high. So that as long as we have a weak US dollar and higher interest rate, then there will be a rotation into the value asset classes. So we have financial sector leading the market. So sectors that were lagging the market, financials and industrials, on weak dollar and high interest rate, continue to outperform the market. Industrials are up 4%, financials were up as much as 5%. Retesting 200-day moving average. We have airline sector like Delta Airline, continue to outperform. Marriott hotels continue to outperform and doing a catch-up with hotels. So leisure, casino, sectors that were lagging the market are continuing to outperform. Technology, the leaders are retesting 52-week high. Doesn't look like it's breaking out through the 52-week high. Healthcare sector is not making new all-time highs, and biotech. So that's probably the only negative that I can see in the current market rally, is that the leaders of the market, what were the leaders in April and May, are not breaking out into new all-time highs. Semiconductors are trying to break through the 52-week high, so that's positive. And then let's look at the rest of the sectors. So we talk about NASDAQ. Junk bonds are facing 200-day moving average, so it's facing a lot of overhead resistance. Metals and miners close to the 200-day moving average. We talked about Europe, very strong rally. Germany is almost at the 52-week high, positive for the year, or close to positive for the year. Germany, China is above 200-day moving average. Home builders staying above 200-day moving average. Energy, commodities are rallying on the weak US dollar. Defensive sectors are 200-day moving average for consumer staples. Utilities are right at the 200-day moving average. So short term, I think potentially market can pull back to 310 or 300-day moving average, a 200-day moving average. But I think there's got to be some kind of negative news to do that. Otherwise, market is overbought. So I think next week there will be a short-term pullback, but this is going to be a shallow pullback, and at least until June, shallow pullbacks. And I would not be surprised that the market will be at 340. Once the earnings season starts, again, it just depends on the news. If I think if the earnings are strong and the economy is recovering at the pace that we have seen with the unemployment numbers today, then maybe 10% pullback. But short term, I think market is overbought, and I personally would not chase the market at these levels. I think the best of the rally at this point is over. There might be a couple more weeks that the market is going to continue going higher, potentially to the 340 level, but I think short-term market is overbought. All right, so how do you trade in current market conditions? Very important to have a trading plan, right? Trading plan, I think, is the most important part. It's very hard to predict the unemployment numbers. Most of the people, including myself, expected that the unemployment number will continue to be higher, potentially reaching 18, 20%. Unemployment rate has actually dropped. So there's certain news that you have no control over. So it's very important to concentrate on things that we can't control. What we can control is cash. On average, I have 30% of my portfolio in cash. So that's the first rule that I would write down in the trading plan. And the second rule is portfolio. Okay, Paula, thank you. Portfolio drawdown. how many positions I have, and what are the stop losses on all of the positions and across my portfolio. So on average, I have less than 10 positions, around 10 positions. Most of them are options, some of them are stocks. The maximum loss on options positions are 5%. So if I trade options or option spreads and I hold them overnight or condors, then I allocate less than 5% of my portfolio. And my goal is 50% stop loss. So if I have 10 positions and I allocate 5% to each, that's 50%. And then if the 50% stop loss, then my maximum loss is 25%. And this is something I always write down in my trading journal to make sure I don't overtrade my account. This is pretty aggressive because I have more experience. I've been trading, for the past 20 years, and this is something that I'm comfortable in terms of risk versus reward. If I do see market overbought, then I downsize the position. So instead of 10, maybe you have 6 or 7 positions. You can see instead of 5% allocation, I probably do 2.5% allocation now and trim a lot of my positions. But that's the second most important rule that I find very useful, making sure that I don't get caught off guard whether unemployment numbers are high or unemployment numbers are low. So cash, portfolio drawdown. The third one is managing position entry and exit based on probability of success, right? I think right now market is overbought, and I would not chase at this point the market. I'm slowly trimming, every day trimming my positions and taking profits in financial sector, in airline sector, and structuring trade based on probability of success and return on capital. So I'm going to go over stock forecast toolbox and show you how to find the support and resistance levels. So that's the trading plan. Cash, portfolio drawdown, always write down support and resistance. Market is above 200-day moving average. Is it above 50-day moving average? Let's see. So it is above. So it's at the upper band of Bollinger Band, so it is overbought. So, but I would put it's above 50-day moving average. It's above 200-day moving average. 50-day moving average is still below 200-day moving average, but trading above 200-day moving average is very important for the market, and that's something that I would put in my trading journal and trading plan to make sure that when I place my trades, I know where the support and resistance levels are. And I'm using stock forecast toolbox and seasonal chart to find these support and resistance levels. And have, outlook on the market is also important. I think short-term market is overbought and potentially can pull back 10-15% in the summer based on the next earnings season. But as we approach in the elections, the next level of unknown, I think the path of least resistance is to continue going higher. All right, so that's the trading plan. Very important to have a trading plan. The next thing is to have a trading journal, right? So it's relatively easy to have a trading plan, have a couple of slides, write down the rule. Okay, how much cash I'm going to have, how many positions I'm going to have, what is my stop loss, what is my target gain. Look at different signals. We have active trader, weekly trader, a monthly trader. So it's very quickly you can pick up these rules and have a trading plan. What takes a little bit longer and takes discipline and takes practice is the actual trading. So trading journal is very important because trading journal, to me, when you write things down, you remember them easier, right? I usually don't remember what I did in February before the market sold off, or in 2018, December 2019 when the market sold off. So feeling of complacency and what do you do when the market continues to go around. So that's very important. So trading journal gives me an opportunity to see if there is a gap between what I'm planning to do and what I actually do. and I grade myself. So I encourage everybody to do the same thing. In our live trading room, we have morning session and the night opening bell and the closing bell. And I maintain trading journal that I share with the users, and I also have my own private trading journal where I put deeper feelings, deeper thoughts that I don't want to share with everybody. I encourage you to do the same thing. Have a written down trading journal where you actually basically say, what did I plan and what did I actually do? In the trading journal, very important for me is doing forward-looking scenarios, right? Do time traveling where you go through future scenario cases and basically closing my eyes and say, okay, what if I'm wrong? What if market continues to go higher and it will reach 340 and maybe 360 level, right? Nobody expected, but now that we still have a couple more weeks in June and unemployment numbers are great and PMI numbers are better than expected and retail numbers are going to improve as people go back to work. Potentially market can reach 340, maybe break to the new highs, 350 level. So then I'm closing my eyes and imagine what will happen to my portfolio. Do I have too many hedges? Is my portfolio diversified? What is my cash? And what is my portfolio drawdown will look like? And then I'm closing my eyes and imagine, after 4th of July, companies will announce earnings, banks will announce earnings, maybe a default rate is higher on credit cards, on the mortgages higher than expected. Maybe more companies are going out of business that people are expecting. And then there's, potential 10 to 15% pullback. And maybe we're going back to 280, 270 levels. So I'm closing my eyes and looking, how many positions again I have, how much cash do I have? Was I able to hedge my positions? Do I have too much exposure to the market? So these are very important decisions in terms of, and they're personal decisions, depending on where you are in the journey of trading and where you are on the spectrum of risk taking. That's what will determine how successful you are in trading. So Yellow Tunnel is the great site resources where we talk about trading discipline. We talk about trend analysis from the, including psychology point of view and market plan, where we have Dr. Maneker and I building different webinars where you can actually go back and review different topics on trading, but also on trading psychology. So I encourage you to review and register for this site where you can get a lot of, and blog different topics on trading psychology, different topics on the market analysis, power trading markets, trend analysis. So combination of both trading psychology and signals for more aggressive traders. If you're looking for more trading ideas and you're further along in your trading journey, right? Dr. Maneker talks about trading journey. If you're a beginner, you probably don't really spend a lot of time thinking about emotional intelligence and how to be self-aware and realizing that emotions will make your trading decision. But as you get further along in the trading journey, if you trade for, I would say, live through few sell-offs, then you will realize that often when volatility rises, you make decisions based on how you feel, right? And what emotions you're experiencing. It has nothing to do with the market, the outer market, right? There's inner market and there's the outer market. So once you get further along in your trading journey, I think Yellow Tunnel and becomes more important. So that's the idea behind the Yellow Tunnel. And then you will want to have more flexibility in your trading decisions, right? More signals for active trader, for weekly trader. So these are the tools and services in Yellow Tunnel. Aggressive Power Trader, we're probably going to release in the next couple of weeks, Aggressive Power Trader Weekly, where we have weekly signals, daily signals, and monthly. Instead of three trade ideas a day or a week, you will have as many as models provide. So trading psychology is important. I would, in a live trading room, we document how we feel. We're doing labeling exercise that are also very important. Right, so how do you trade in current market conditions? We talked about trading, importance of trading plan, trading psychology, and trading journal. Back trim XLU. I did trim XLU, and now I have a debit spread. I'll talk about XLU position. But how do you trade in the current market condition? We had, Buck had a question about utilities. So we do have a live trading room. Elite Circle is the subscription at Tradespoon that gives you access to everything that Tradespoon has to offer. We have a morning live trading room, morning bell, closing bell, and you have a trader log, right? And SMS alert. So a lot of people ask me, Vlad, we want to know not only during live trading room, but anytime you do any adjustments or anytime you trade, right? Because market is volatile. Sometimes I can adjust position during live trading room. Sometimes, the market trade, I would have to adjust outside of the trading room, or some people don't have time to watch the live trading room, but they want to know, what I'm doing in terms of all the trades. So you can get an SMS alert and trader log if you're part of the Elite Trading Circle. And you can see all of the trades that I'm doing. So like Delta Airline, I trimmed the position. I continue to trim Delta Airline position as it continues to rally, close, half of my position that's left at 37.11. And partially close the earnings strategy. If you want to know what I trade on XLU, then you can go in and say, what were the trades in the past 60 days for XLU, and you can see that I closed actually 50-60 call spread, right? So I closed 50-60 call spread, and I didn't trim my position, the remaining position, but I lagged into a spread, right? I continue to sell 66 call against the 64 call that I have. So now I have a debit spread because I think short-term utilities are over bought, but especially with a high interest rate. But I think they're going to continue to go higher by end of September. So you can see different trades that I have done, whether it's legging into a spread, sold to open 66 call. So so I'm still net long utilities sector. So that's Elite Circle that gives you morning bell, closing bell, traders log. You can see, let's look, you have quite different variety of different trades that I'm doing. So Delta Airline, right? And you can actually see that this is a long-term trade, and this is a stock position that I do dollar cost average and trade around stock position. Sienna is an example of the earnings strategy. Short-term trade. On short-term trade, I look for 0.5% gain, 1% stop loss, and all of this are my trading journal that I go over in the morning bell and closing bell. We talked about utilities. I continue to lag into a debit spread, 64.66 call spread. I'm doing short-term trade, like active trader. So active trader or aggressive power trader, right? If you go back to aggressive power trader and you're looking for more choices, right? We've seen, you can actually judge by how many symbols aggressive power trader model provides. The more symbols, the wider the rally across different asset classes. Because for today, we had insurance companies, Ford, consumer discretionary, industrials, Harley Davidson, McDonald's. All of these stocks are in confirmed uptrend, and the more sectors the model provides signal on, and the more symbols, the wider, the more powerful, the more momentum is behind the rally. And if you want to go back to what were the recommendations for prior day, then you can see Disney, ETN. And these are the symbols that I'm actually trading in a live trading room environment. So ETN was an example of aggressive trader model. For short-term aggressive trader, these are short-term trades, right? Aggressive power trader, active trader, Tradespoon, these are short-term trades. I'm looking for 0.5% gain in this example, I think vice versa, but it's 0.5% gain, 1% stop loss, right? And in this example, sometimes I trade stock, sometimes I would trade options. So at the end, I sold the credit spread, right, and close it for 10 cents. Looking again for 0.5% profit on short-term trade. And same thing was with JP Morgan. Active trader looking for 0.5%, 1% stop loss, 1% stop loss, 0.5% target gain. Also trade spreads. So in the premium service, I trade spreads like Square. So it's a mixture of short-term trade like Active Trader and then long-term trade like Square and Delta Airline. So that's Elite Circle and different types of trading you can expect in live trading room. And it's a combination of Active Trader, Weekly Trader, and Monthly Trader. So that's Elite Circle. Then the premium portfolio, Square, the example of Square trade, which you can see here, this is geared towards somebody who maybe doesn't have time to be in the live trading all the time and looking for maybe one trade a week, 2 trades a week. So example of premium service is, every week we issue a trade idea. So on June 1st, issue an idea of Square, basically saying buy it at $81 or buy a spread at $3.30. And you can actually see the trades. You get email and SMS message every time I trade. So the premium service gives you exposure to 1 trade a week. I personally trade option spreads. The signal gets generated on Sunday. You have time to do your own research, look at the stock chart. It was recommended $81. It's made significant move to the upside, trading at $89. You can see the probability, what the model makes prediction. So you can see based on the seasonal chart and the bulls and bears, the long-term model makes prediction. 3 out of 4 predictions are higher. So if you see a stock where on average 3 to 4% higher, then you look at the accuracy, right? One of the rules in my journal is probability of success versus return on capital. So I know Square, if 3 out of 4 predictions are higher, then there's accuracy of about 80%. So in the past, when the same signal has been generated, the model is confident. The model provides you confidence level. The neural networks gives you a number, like MATLAB or RScript. They give you a number of how confident the model that this pattern will repeat itself again. So you never have 100% accuracy, but we're able to achieve 75%, 80% accuracy that the average price of Square on the time that the signal was generated will be higher than for the next 50 days. And you could look at 1 standard deviation move, 2 standard deviation moves for the stock in terms of what your expectations of where the stock can trade. Also instructional video. If you want to learn how to trade options or you want to know the reasons why I got into a trade, what my view on the market, then you can review instructional video that explains you. So it's a great way to learn how to trade options. Or if you already know how to trade options, what is the reason of getting into the trade? So premium portfolio, less trading, geared toward having maybe 4 or 5 positions where average holding time 20 to 30 days, and there is 1 trade idea a week. And I personally trade option spreads. And you get email and SMS message along with nightly video that explains why I get into the trade or if there's any adjustments. The next portfolio is Robo Investor. Robo Investor, a lot of our subscribers are not comfortable trading options. Options, it takes time to get comfortable with options. It's you need to always think not only on direction, but also on the time and the premium and volatility. So there's different variables you have to think about. So it's definitely takes time. It's more complicated product. It does give you certain advantages. You can leverage your portfolio, you can hedge your portfolio with options, so you can reduce your cost basis. So definitely has advantages, but nonetheless, some subscribers don't feel comfortable trading options. So then we have Robo Investor portfolio that gives you newsletter every other week. So every other week you get a newsletter with 2 trade ideas, right? So you can see portfolio of all the open trades, the entry price, the closing prices, any orders to close a position. And again, you get email and SMS alert every time I trade. And this portfolio consists of only stocks. The advantages of stocks is that I don't have to be correct on I don't have to worry about time decay. I don't have to worry about timing as much. As long as I am correct on the direction, then I have times on my side. So this is a portfolio of maybe less than 20 stocks, and the idea is to allocate less than 5% of your portfolio into each stock. And you can see the performance of my live trading room environment. You can also consist of all, stock up, active trader, weekly trader, and monthly trader. And you can also see portfolio performance of just the Robo Investor trades. Let me look at the question. So every trade that you see, so Faye had a question, am I doing these trades? Yes. So this trader log is actually, this is not something that I manually enter, right? Or, I choose to pick some trades and some trades I choose not to publish. This is a very unique product that I don't think, I haven't seen anybody's doing this. This is where I'm actually, through an API, I'm synchronizing with my brokerage account. So you have real-time exposure to every time I trade. So you, instead of watching how I'm trading during live trading room environment, you actually have access to it all the time. So this is synchronized. These are the trades that I'm actually making in my brokerage account. If you've seen if you've ever been in the live trading room account, you will actually see as soon as I enter this trade, the trade appears in this trader log. Sorry, if you appear, I use Trading Block. So I do use Trading Block account, and you can see the relationship between Trading Block and Tradespoon. So I do use Trading Block account, Ricardo. Question is, very good question, why is target less than stop loss? The reason, this is again going back to how much risk probability of success versus return on capital. So let's say for Sienna, let's look at Sienna or Adobe Broadcom. We just did Broadcom. So Broadcom, I sold the trade for 80 cents, right? It's probably trading around 5 to 10 cents. It's the iron condor, $10 wide condor. So I'm risking basically $9.20 to make 80 cents. Right, or in the example of JP Morgan, right, shorter term trade. I'm looking for 0.5% gain, but my stop loss is 1%. And then the question is why? So great question, and this goes back to the concept of probability of success and return on capital, right? So if probability of success, right? If the probability of success, I have horrible handwriting, always did. If you want to increase the probability of success, like I did on Broadcom or Sienna or JP Morgan, right? Then you sell out of the money options, and if it's a short-term trade, I look for 0.5% gain, right? My idea, based on our research, is that S&P stocks move less than 1% a day. So on short-term price fluctuations, I look 0.5%. Stop loss, again, based on our research, the entry point is at predicted low. Then I know that 80% of the time, the market will revert from this entry point in my direction. So I choose to straight improve on probability of success, but then I'm decreasing return on capital, right? So that's why I have, for $1 loss, I look for 0.5% gain. I can structure my trade where I look on JP Morgan, if I risk $1, right, I could sell this for $1, and my maximum gain is $1. And that's totally fine. then my probability of success will decrease, right? Because I'm looking for what bigger moves, and my return on capital will increase. So every time you trade, this is a choice that you have. They're both strategies are totally fine. You can, and we've seen unusual option activity, on CNBC, where quite often it's mentioned, well, there's unusual option activity. I invested $1 and I made $3, or I made $4. That strategy totally works, but you have to have kind of a long-term perspective on trading. If you risk it $1 to make $1, then most likely you will not be able to have 75% or 80% accuracy on these short-term trade. If you look in, every time you look for $1 risk, $2 reward, or $1 risk, $3 reward, your probability of success over a long term, I mean, you can have streaks, but over a long term, most likely will be less than 50%, right? So, or if you trade in order to do that, you have to trade out of the money options. And we know that when you buy calls, most people buy calls and puts, 90% of the time, these out of the money options, for you to achieve 1-to-1 or 1-to-2, you have to buy out of the money options. Or the stock, if you buy in the money options, the stock has to make a move that's outside of the predicted range. So that's fine. So you can structure your trade that way, but then you have to look if you're, if you're doing let's say you're risking $1 to make $2, you have to basically look at your percentage of winning trades and make sure that your winning trades will be greater than your losing trades, right? Because 50% of the time you will lose that $1, right? And the other 50% of the time, maybe you'll make 1-to-2, right? So you have to be at least 50% correct to break even, right? So then you need to have some kind of edge where it's more than 50%. Maybe it's unusual options activity, maybe it's your own view on the technical analysis, but it's not really important whether you structure your trade 1-to-2, 1-to-3, or 0.5%. What's important is to look at the combination of not only return on capital, but also probability of success, how often you will be correct. And to make sure, in both cases, you can lose money. If I'm right 80% of the time, but I cut my winners short and I let my losing trades go too far, I will lose money, right? And the vice versa. You can structure your trade where for $1 of risk, you can make $5, but if you have 10 losing trades that exceeds these $4 gain on the winning trade, you will lose money. So in both scenarios, you can lose money. The question is, do you have a trading plan and long-term perspective? In my case, I'm more risk averse, and I personally, what fits my psychology is higher probability of success. So I'm trading where I get 75% accuracy. And let's say if you look at the stock forecast toolbox, let's say JP Morgan, the idea is to buy at predicted low, 101.51, and sell at predicted high, 108.76, right? When the stock is at 110.92, it is overbought, right? Because of unemployment numbers today, really. So that is the main reason. Usually JP Morgan doesn't move 4%, right? And usually JP Morgan moves less. I mean, there could be volatile times, but it's less than 1% move on average. So that's the reason of the ratio. But it's a very good question, and that's basically depends on your trading psychology. I don't think there is a right or wrong answer. I know usually when you start trading or you're new to trading, you like 1-to-2 risk versus reward, or 1-to-10. It makes complete sense. People are looking for home runs, but as time goes on and you collect more data about your trading, I encourage you to write down your trades in your trading journal and just see what is your percentage of winning trades. And any ratios are fine. There are some strategies where you're 99% accurate, right? You sell out of the money puts, the 20-30% out of the money puts, you collect a nickel and a dime, and you're 95% accurate. But it still doesn't guarantee that over a long period of time your portfolio will grow. Because one time when the trade goes against you, it can wipe out 15 one winning trade can wipe out, one losing trade can wipe out 15 winning trades prior to that. So good question, and something that I encourage you to think about. Questions? Kashik? Losses on Spiders 230 put expire June 30th. I mean, losses, I assume you bought a 230 put. I mean, right now, yeah, 230 put is way out of the money, so I'm not sure how you can repair that trade. I assume it's already worthless. So I would just forget about this trade and move on to the next trade. Say the Amazon trade is right. So the Amazon trade, I think I understand what the issue is, but I think this was last week. Yeah, so Amazon trade. Here we're looking for 5% stop loss, right? So if you look at the options, so this is a signal was generated on May 26, right? So on May 26, if you enter the trade, let's say at 24.25, right? We're suggesting to, if you want to leverage your portfolio, you can buy 12300 call, which will cost you $124.85. We're trying to minimize options, so we're buying in the money option. So you buy one contract for 124.85, and our stop loss is 5%. On monthly trading, the suggested stop loss is 5%. So 5% stop loss, that's roughly $120, right? 5% of where the stock is trading, 2,400, that's $120. So 124 minus 120, stop loss is at 360. I agree, if you buy 124 call and it reaches 360, you might as well wait and see if it rebounds. But that's the calculation. We take it, I mean, you can take it, you can buy 2200 call for $224, and then the stop loss will be $124. But that's the math. The idea is to buy deep in the money call, leverage your portfolio instead of spending $24.64 for 100 shares. That's $246,000. Most people don't have that. Don't trade these large portfolios. So you would buy one contract, and that's where the stop of $3.60. The way these prices are calculated for active trader or monthly trader, we look at the predicted low. Predicted low is based on the stock price. So 2300 plus 124, that's 2424. So the model predicted that 2424 is going to be the low. So you can buy the 2424 the stock, or you can buy 2300 call for $124, right? Because that's the predicted low. And in this case, you would be up, maybe 1.5% at this point. Or you can buy at previous session close, which was 2300, so 2446, and then you would be up maybe only 1%. So you always have a choice. We give you strategy A or strategy B. Strategy A, usually if you see the market is down, then we are suggesting to use stock forecast toolbox and buy at the predicted low. Right, so it's the Tradespoon. If you ever, I encourage you to look at the live trading room recording. In a live trading room recording, if the market goes to 319 and the model predicted 317, I usually don't chase the market, right? I don't chase the market, and I wait either for predicted low or from previous session close. If the market retraces back to 312 level, I think that would be a good entry price. But at 320, it's way overbought, and I would not chase the market at these levels. So hopefully that explains you how we make this trading decision. And same thing for active trader, right? Today, active trader, United Airlines was one of the stocks suggested to buy. And again, the entry price is 39.10, previous session close. If you see that pre-market unemployment numbers were 99% of the people could not imagine that we will have such a great numbers. So if you see market rally 2% before market opens, then most likely United Airlines will not retrace back to 33.98, right? I would enter strategy A if I see that the unemployment numbers were disappointing, right? If the May unemployment numbers were disappointing, then I would not chase the market and I would wait for 33.98. But because the unemployment numbers were great, the entry point would be 39.10. So if you see market pull back to 40 level, then I would consider entering United Airlines. Otherwise, I would not chase, right? Because it's way over bought. So that's how you would use this active trader, either based on our model or based on previous session close. Those are the choices. And if you want to leverage your portfolio on options, then instead of 100 shares of $33 stock, that would be $3,300. Instead, you could buy 33 call only for $1, or for $6 if you want to wait for the previous close price. But these prices are always calculated by looking at the stock price minus the strike, right? So if the previous close is $40, right, 39.10 is the previous close is 39.10, then you take 39.10 minus 33. This is how we arrive at $6.10. A very common question is, Vlad, what if it never reaches $6.10? We do give you standard deviation of error where you can consider entering the price, but I usually, if the stock is at 45, 48, I would not chase the stock. I judge my risk averseness by how well I sleep at night with my position in play. So Bob, has been trading more than, for a few years, if I have to guess. So yes, one of the decisions, as you are going through your trading journey, Bob has a good point. And what I learned from Dr. Maneker is that you make your entry and exits on your positions and how much you want to allocate by, well, how much sleep you want to get every night. That's one way to look at it. But I look at it, again, through this term that Dr. Maneker coined is fear of future regret, right? If I'm 100% in cash right now, because I think market is overbought, right? I personally think 320 is way overbought. Yes, unemployment numbers are great, but there's still too many unknowns, right? Social unrest, conflict with China. We have no idea what the earnings will look like. We don't know at what point unemployment numbers will drop back to, there's elections. So blah, 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 blah. But that doesn't mean, and we historically, we are, beyond 2 standard deviation move. So, 90% of the time, market does revert back to its mean. So around 300, 310. But, but I also could be wrong, right? Because the dollar is continuing to sell off. There is unprecedented stimulus package in Europe. Treasury is selling off, dollar is selling off. All of that fuels the rally, right? And you don't trade against the Fed. So then I'm closing my eyes and imagine, potentially in the next 3 weeks, market could be at 340, right? We just went from 300 to 320 in the matter of a week. A couple more good microeconomic news and we'll be at 340, right? Because of the fear of missing out. So I'm closing my eyes and I'm imagining, what will my portfolio look like at 340? And if I'm 100% in cash or if I'm under allocated, then, that's what drives my decision to still buy Square this week, right? Because I know that I've raised cash, I know how many positions I have, so I'm taking more risk on companies like Delta Airlines and Square. And that's the reason I still go long, even though I think that the market is overbought, and I'm actually surprised to see it, 321 level. Then I'm closing my eyes, right? So that's one scenario. The fear of future regret, not fear of missing out, but fear of future regret. And the difference, fear of missing out, is what you're feeling right now. And you don't want to trade based on how you're feeling today, but you do want to trade how you will feel in the future if certain event happens. Right? So I want to make sure that if market is at 340, I don't feel disappointed that I didn't put enough cash. Right? So that's the idea of making sure that you can sleep at night, and the idea of that in the future you want to be prepared for both outcomes. The second scenario is unemployment numbers are staying elevated. China is not buying agricultural products. They're coming out of the phase one agreement. Trump is losing his ratings, and Democrats, the probability that Democrats will take power is increasing as we approach the next elections. And then the market realizing that this recession, it's not a V-shaped recovery, it's a U-shaped recovery. And then the market is at 280, right, or 290. So then again, what will my portfolio look like? Do I have too many positions? Will my portfolio drawdown be more than 20-25%? How will I feel in July or August if the market is at 280? And then that's what prevents me from having too many positions, and that is the main reason why I downsized the Delta airline, why I downsized the Square, because I'm realizing that both scenarios have very high probabilities, right? I personally think that we'll get to 290, 280 before we get to 340 at this point. So I don't want to change the market, but I do realize there is high probability of both events, and that's what drives my decisions of how will I feel in the future. Not how that I'm fear of missing out and I'm piling into a trend, but what will I feel July or September if the market reaches both extremes. Trader deck, I didn't trade deck. I don't have a position. Again, exiting and entering position, right? Had a great earnings, positive surprise on the earnings, 52-week high, broke 52-week high. Again, everybody has different reasons. I don't look at actually gains and losses. I don't look at, deck can continue going higher or it can drop. You can put a stop loss and say, listen, it broke 200 level. As long as it's trading above 200 level, I'm going to keep this trade on, and I have a clearly defined stop levels. So that's one way of looking at this. Another I don't know where you entered that. Maybe you did it before the earnings, maybe after, but you always have target gain and stop loss, right? If you invested $1 and you made $1, and that's your stop, that's your target gain, then I would exit position or trim position, right? I don't look at, the reason I exit Square half of the position is not because I don't think Square is going to continue going higher, but because I have too much exposure to the market, and I do realize that this could be a false breakout and Square can pull back, right? Faust, how often the intraday toolbox is updated and should be used on day trading options? So aggressive power trader, I do trade. These are updated each day. I would encourage you to look at 8 p.m. Central and 8:30 a.m. Central, but it's updated once a day in terms of number of symbols, and the quotes updated periodically. This is delayed quotes, but you can see the quotes updated, and you can also will give you choice of option trades. So if you're trading options and you're doing short-term trading like I did with JP Morgan, right? This is an example of short-term trade. Open the same day, close the same day. Literally held the position for 20 minutes. Then then active trader and aggressive power trader. Both active trader, the advantage is again depends on where you are on the risk spectrum. Some people are looking for 3 trade ideas a day, United Airlines and Allstate and Hug, and they're totally fine. They don't have too many choices. But some people want to know the breadth of the rally and different sectors. So here, you get a lot more choices. So it just depends what you're comfortable with. Chris, thank you for your comments. Dow938, thank you. Faye, sorry about the sound. Chris, thank you. Faye. Yeah, LK, we've talked about LK. Anytime there is any type of accounting issues, I would stay away from. This is all driven by news. I believe, just from my personal trading, so you understand, my background is computer science and statistics. Computer science and statistics works great when there are no news on daily basis. So when you have accounting irregularities, it's hard to predict where the stock is going to be. So I personally don't have an opinion. Okay, I personally would stay away from it. JP Morgan, what was the percentage gain? 0.5%. Well, if you look at the stock, right? So $100 stock, I sold for 78 cents, 41, 37 cents. So it's 37 basis points. All right, guys, that's all I have for today. Thank you very much. Okay, all right, that's perfect. It's definitely up today significantly. So, Carmen, thank you. VIX is stubbornly high. It's continued to make new lows. People are holding their position. When June expires, I think VIX is going to drop. It's already at the historical average. Historical average is 20. We're at 24. So for all the practical purposes, people are still holding on their hedges. But once June contracts retire, and we don't have any black swan events, I think VIX is going to continue dropping to 20 level. Ricardo, it's up to you. You can trade 1 contract, 2, 3 contracts. It depends. The loss should be less than 5%. Klaus, Shabbat Shalom. Faye, thank you for your comments. Have a great weekend, everybody. Enjoy your weekend. Spend some time with your friends and family. Thank you for participation. We have a lot of people. I appreciate your time. Get recharged, and I hope to see everybody in the live trading room on Monday. Thank you very much, and have a great weekend.